I'm Vincent Devall here with my partner and friend, Brad Brewer.
As you can see, we're both really dressed up today. Hey,
Yes.
everybody. Today we're tackling a topic that every home buyer eventually faces: mortgage terms.
Yeah.
Those little those little phrases on your paperwork that sound like they're belong in a finance class, maybe an attorney's office, whatever. But really, it's just explained in plain English, and we're going to go over with you today.
Yeah, exactly. And we're gonna try not putting you to sleep. Okay, I'm not making any promises. Now, keep in mind, we're not exactly mortgage brokers or lenders, but we've been doing real estate for a pretty long time. We'll mix in some real life stories, a few comparisons, raising kids, maybe managing a real estate team, and because Brad's here, probably some wine talk.
I do like wine.
I know.
Oh, and of course, if there's going to be wine talk, but let's start with the mortgage stuff. So let's take a trip. What people might remember or talk about is the ARM, adjustable rate mortgage. That's our first mortgage we're going to talk about.
Yeah. So an ARM starts off with a fixed interest rate for a certain number of years. So maybe it's 2, 3, 5, 7. All depending, and then it adjusts periodically based on market conditions.
Think of it like your oldest daughter, or in my case, my only daughter. At first, you've got her on your schedule, bedtime at 8, snack time at 3, and everything feels predictable. Then somewhere around middle school, the rules change. You've got to adjust, adapt. Sometimes you just kind of wing it and hope for the best and hope not to screw up their lives.
Exactly. ARMs could be great if you know you're not staying in a home for long. But if you plan to settle in, you've got to be ready for that teenage phase when the rate changes.
I like the fact that you just compared an adjustable rate mortgage to a teenager.
Yeah.
A teenage girl, no less.
Yeah, right.
Are one of these other mortgages we going to compare to a teenage boy at some point?
I don't know. I have 2 daughters. You have a daughter, so probably
not.
Probably stay with.
We'd be even more clueless on how to raise boys, even though we are one.
Yeah,
we're
right.
one. Anyway, now compare your adjustable to that conventional loan. Your steady, reliable option. This is your seasoned real estate team member who shows up on time, knows the process, and doesn't need constant hand-holding. So which basically means your interest rate's not going to change.
Right. And then there are government-backed programs, FHA, VA, HUD, even local programs like we have in here in Wisconsin, our WIDO program. So there's other ones out there besides our ARM and our conventional.
Yeah, let's break it down a little bit. So first, FHA. It's perfect for folks who might have a smaller down payment, typically around 3.5% down is pretty much. I haven't really heard of too many FHAs that are any less. I think I've heard of a 3%, but it's pretty standard at 3.5%. Might have a few credit dings are allowed with the FHA. It's like that rookie agent who doesn't have all the experience yet, but the right tools to succeed with some guidance, like from their team leaders.
Yeah, exactly. VA loans. I do a Homes for Heroes program, and VA loans are very popular with that program. And VA loans, hands down, is one of the best programs and benefits for our veterans out there today. Typically, no down payment, competitive rates, fewer fees. And if you've served, it's like being given front row seats to the biggest game of the year. Earned and well deserved. The other cool thing about VA loans, a lot of people don't realize it, that because you had a VA loan previously, that doesn't disqualify you from getting another VA loan. Right. So your benefits don't exhaust, it's not a one and done type deal. So if you had one, you can typically get a second one.
VA loans are really, really perfect for our veterans.
Yeah.
There's a lot of benefits for our veterans that have that loan. It's actually a very clean loan. There are some protections to it, but sellers, sometimes we get sellers a little hesitant with VA loans. You should not be. There's a little extra protections. And by the way, all these have a form that has to be signed by all parties. The basis says the government can not do this loan at any time. I've never had that happen in my 10, 11 plus years in real estate. So don't be afraid of the FHA, the VA, USDA, and then of course WIDA products. WIDA is actually a conventional loan, but maybe we'll get into that another time. So we're trying to keep it basic.
Right.
Anyway, so let's go into a little bit of some of the nuts and bolts. Amortization. That's just the schedule of how your loan gets paid down over time.
The scariest, like 10 pages of your loan document.
Yeah, it's early on, most of your payments are going towards interest as you get further along. Now, I will tell you, it can scare you because if you do look at the end of those 7 pages, you look how much interest that you're gonna pay over that 30-year mortgage or 20-year mortgage. Actually, if you look at the 20-year versus 30-year, you're gonna feel a lot better about the 20.
Right.
But again, there's ways, and I know really good lenders talk about this, and I know I mentioned it too. There's ways of paying extra on that could cut years off your.
Oh, yeah. Yeah, I mean, it could be as simple as just $50 extra a month, right?
$50, $100 extra a month can shave, literally the 30-year mortgage, shave it down 6, 7, 8
Yeah.
years sometimes.
I even tell people, if you get paid on a bi-weekly basis, just every 2 weeks, cut your mortgage payment in half.
Yep.
Pay, if your mortgage payment is $2,000, pay $1,000 on the 15th, $1,000 on the 30th. Every month, no matter what, you eventually will, or every 2 weeks, sorry. So whatever that works out to be in your pay periods, you'll eventually make one extra payment, full payment to your mortgage
Annually.
Yeah. And it's going to cut that time off. So it's kind of like managing a new agent, right? At the beginning, you're investing a lot of your time, resources before you see those big results. But over time, the payoff grows and it's worth it, right?
Absolutely.
So yeah.
Yeah, and then of course we've got APR, annual percentage rate. It's like wine pricing. The sticker price isn't always the full story. APR includes the interest rate and the fees, giving you the true cost of exactly what you're borrowing as far as the money.
Right, yeah. Also, appraisal. Appraisal is how we find our value in our home and make sure you're paying, what your home's really worth. Now, appraisal is going to be based on, recent sales in the area, similar property condition, or similar size, ranch versus ranch, 2-story versus 2-story. You're not going to compare a ranch to a 2-story on 5 acres, right?
Yeah.
Out in the county. So appraisal is key. It also has to be done by a licensed appraiser. So the bank sends out a neutral party that evaluates it and then gives us a number that hopefully is right about on the, if not more than the price we offer, at the price we offer.
Right. So I'm gonna ask Vince a question on the appraisal, but first, before that, I'm gonna tell you about assessed value. That's what your local tax assessor, since your county says your house is worth, which might be higher, might be lower, or somewhere in between. As a homeowner, you always want your assessed value to be listed as less, because assessed value contributes to what you're going to pay on your property taxes. And of course, everybody wants those to be as less as possible. So if you find out you want your assessed value to be less than your appraised value, much less, because that's less than your market value technically, right?
Right.
Now, what do you do, Vince, if your assessed value is currently over what you know is your market value?
So let me make sure. So if my assessed value of my home is worth $500,000, but I know I can only sell my house for $400,000. It's kind of funny. We just got our assessment for our house in Wheatland, and it ended up benefiting us. Let's just leave it at that.
His less.
Exactly. So what you would do is you would go and work with a local real estate agent like ourselves, so your agent directly, and ask them to look for comps, ask them to look for comparables that they can provide you, so you can go and fight it with the assessor's office. And typically when you get your assessed value or your new assessment, there's going to be some dates and timelines on there that if you want to fight your assessed value. I actually did this with my Lake Geneva investment properties about 2 years ago now, and it worked out. So I used current data to kind of argue that those duplexes are not worth what they thought they were worth. So
or if you just took out like a HELOC, which we're going to be talking about next, or you just purchased your home and for some reason the assessed value went above what your appraisal is. A lot of times you can even have the appraisal submitted too, but you can fight that, and I highly encourage it, because you are in fact paying more on property taxes than your home is worth. So definitely a good thing to do.
An assessment is like what you think your daughter's prom dress is worth versus what she really paid for it. Yeah, it's ridiculous. When that time comes, I'm not looking forward to it.
Yeah, that is So I remember that. Anyway, so I just kind of lead to this. Another couple things we're talking about right now are bridge loans, HELOCs, and buy downs. let's start with bridge loans. Bridge loans help you buy a new home before selling your current one. Like a HELOC, home equity line of credit, lets you borrow against the home your equity. It's very similar to that. It's just basically a loan that says, hey, I had this bridge loan to help me while I'm going to buy this one before I sell my last one, basically.
Right, yeah, yeah. It's,
Simplest way to say it.
I actually talked to a lady yesterday that is interested in one of my listings, and she's like, I don't need to sell my house. I can bridge loan my house to buy this one. It just makes sense. So she's like, and you know, it's downsizing for us. It's just kind of a perfect situation for them. Now, buy down is when you or sometimes the seller, all depending on who it is, pay upfront to temporarily lower your interest rate for the first few years. You know, right when interest rates really started to climb there a couple of years ago, we saw a lot of 2-1, 2-1-1 buy, 3-2-1 buy down. So, you know, for the first year, let's say a 2-1 buy down, they're very common today. 2-1 buy down, if the interest rates are 7%, for the first year, your interest rate is going to be 5%. The second year, it's going to be 6%. Third year, it's going to be locked in at what we're at today.
Right.
Not what we're at in the future, but what we're at today. And so what I tell people is, you know, if you really feel like the interest rates are going to drop, then do a 2-1 buy down. When time's right, refinance into a rate that's going to really benefit you. So,
kind of like the same with points. You may have heard this if you've taken out a mortgage before. You're paying to get a lower rate for the life of the loan. It's like investing in a better wine barrel now, so now that the wine tastes better later.
Yeah.
So it's just an upfront investment to get that better interest rate immediately, and it's already been locked in versus the buy down.
Yeah, and you know, I'll just tell you a great example is I just had closed on a deal on Thursday or Friday, and they bought down the rate by 3 points. So it's kind of interesting. Yeah,
that's awesome.
Yeah. Now they had the means to do it, right? There's financial, you know,
Yes.
Need to have a little more money, need to have more cash to close, typically things like that. And cash to close is the amount of money you need to bring to the table to finalize the deal. It's going to be the final number that the lender tells you, says, hey, you know what, you need $22,163.17. Don't ask me to repeat that. I just pulled that number out of the air. But that's kind of where, you know, that's your cash to close. And depending, you might be able to come to closing with, you know, a cashier's check, a personal check, or you might have to have the funds wired. That's where I would say, hey, talk to your title company, figure out what's best for that.
That brings us to closing costs. Those are all the fees, the lender fee, the title fee, attorney fee, recording fees that make that final handshake possible, that the deal is done. It's basically, you know, you've got an army of people.
Yep.
You got us agents. Of course, our commissions on the buyers are typically, even with the laws changing, I haven't had a buyer have to pay commissions yet, but I'll say 99% of the time, it seems like sellers are still paying a commission. So you don't have that, but your lender, you know, all their processing, they got to pay for their offices, they got to pay for their staff. So they have fees, your title company has to have fees, they got to make money too to ensure you're getting a clean deed, all those good things. Of course, when there's attorneys involved, and then the state, the recording fees, things like that. Everybody's got to get their little piece of the pie, if you will.
Right, exactly. And then we come down to the closing disclosure. It's kind of like a report card on your loan. It shows exactly what you're paying, where every dollar is going to you know, to Brad's point there, all those fees and things like that. It shows where every dollar is being dispersed. And you typically get this a few days before closing, so that there's no surprises, so you're not caught off guard. Also, when you get that closing disclosure, you want to make sure that if you're supposed to be getting the credit, or if the seller's supposed to be paying for a home warranty, or you know, if you paid for a well inspection, and that's on there. So you want to make sure that everything's on there, and that's where we as agents also, your agent should be reviewing that as well to make sure that it's exact, you know, accurate to the point that they're aware of as well. So, and
be prepared sometimes on the buyer side, because there's more financial data in the buyer's disclosure. Sometimes you have to give your lender permission to give it to us. We usually we will see a closing statement, an estimated one that's got buyer and seller stuff, but it's got less details than your actual closing disclosure from your lender, which they usually have you sign off on 3 days prior to closing. That way we've got time to make sure everything's correct. So
I only laugh because the last two we ended up seeing on the 12th hour, literally.
yeah, the
4:30 the day before closing.
That's the unfortunate thing. They have to by law give you and have you sign off on one 3 days prior.
Yeah.
But there can be last minute changes.
Right,
So.
right, things that are missed, whatever, so,
Yeah.
yeah.
Okay, next thing we're gonna talk about, part of the underwriting process, something your lender's gonna pay close attention to, is your debt to income ratio. Is your monthly debt divided by your monthly income, is it lower than where lender's going to be, is gonna be willing to work with you? So
Yeah,
essentially, to simply break that down, if I would say it depends on the loan, I'd say usually typically most loans are between 40 and 50%. So they want to make sure that after they've calculated what your mortgage payment is going to be, and then all your other monthly responsibilities, not the total balance on like your car, but what is the minimum payment you have to make on a car payment, maybe a credit card payment. They're going to calculate all that and divide that into what you make. And if those numbers are less than that percentage, again, conventional is usually close to the 40% mark. I don't know if any are less than that. You can go up closer to 50%, because what the lender, of course, wants to make sure of essentially is that this person, after paying all their required bills, are they just sitting around staring at each other? Can we still have a TV account?
quality of life, right?
Some type of quality of life, right?
Yeah, and yeah, so that's huge, debt to income ratio. Also, with that being said, don't go out and, just because they ran your credit, they gave you a pre-approval, don't go out and buy yourself brand new furniture for the house. Don't take out another $10,000 in debt, because they do check these numbers again, a few days prior to closing, even the day before closing, to make sure that they're still in line. So
safest thing to do is what, I know, again, a really good loan officer is going to tell you, and agents say the same thing. We kind of reiterate it. Do not open any lines of credit. Don't
Right.
take out a new car loan. Don't open a new credit card. Even the little stores like the Targets and the Kohl's and stuff like that. Do not open up any new lines of credit. Absolutely none. Zero for even the littlest amount. And try not to really use your credit cards until after. You may say, you're gonna like, oh, I'm gonna put my new credit card. I've got this $10,000 balance, 0% interest for a year. Great, that's a great value. But don't go buy that furniture until the house is closed.
yeah.
So don't even use your credit.
When we talk about spending money, there is one thing that they do allow you to spend money on. That's your earnest money.
Correct.
Earnest money is your deposit when you make an offer. Typically, it's after an accepted offer, where once both parties agree on all the terms, you're going to have the earnest money that shows the seller you're serious.
Mm-hmm.
And that money goes towards your closing costs, your down payment, whatever that might be, part of the purchase. Okay, doesn't go directly to the seller. I think that's a big misconception on a lot of buyers. Are like, oh, the seller gets that on top of the $300,000 I'm offering. No, that's your money that is going towards your purchase.
Exactly. Equity. That's how much of your home you actually truly own. So over time, like training a new agent or raising a child, that equity grows as they put more work into it and make smart choices. So essentially, when you buy your home, if your home is worth $400,000, and to get your home, you've borrowed $350,000, you're essentially walking your home with $50,000 in equity, right?
Right.
So that's your usable money. That's where, when we were talking about home equity lines of credit, that dollar amount gets big enough, you can borrow off that extra money to do improvements. Maybe go buy it instead of doing a car loan. Maybe it's cheaper to do a HELOC to buy an automobile. I mean, there's a number of different ways you can use it, right?
Yeah. Now, with your loan, you're obviously paying, we talked about APR earlier. Interest rate is the other side of things. Interest rate is pretty self-explanatory, but highly important. It determines your monthly payment and the total cost of the loan. Mm-hmm. So it's kind of what helps dictate that APR at the end of the day, because it's interest rate plus all of your fees divided across the length of the loan.
Then, of course, there's your loan origination fee. That's literally simply a fee that the lender charges to sell your mortgage.
Yep. And I'll tell people, like, as they're shopping loans or shopping lenders, find out what that loan origination fee is. Some lenders are going to charge you, they're going to tell you, oh, hey, Brad, I can give you an interest rate at 6%. What they don't tell you is our loan origination fee is obscene, and our points, we're going to charge you some points. Okay. So ask those questions and, figure out what the best way to go is like that. We talked earlier about VA, FHA, conventional. US HUD, WIDA, some of those loans are assumable.
Mhm.
And what that means is you could take over someone else's existing loan, often at a lower rate than what's available now.
Mhm.
The caveat to that is though, is that those, if the assumable loan is 200,000, they're selling their house for 400,000, you need to find a way to come up with that other 200,000, right? So you can assume some of it, but you're probably not able to assume enough to buy the full property. So there's a little catch to assumable loans, but if you have the means,
Yeah.
they're a great way to go today.
Yeah, there's some steps there. It can be difficult, but again, if you have a really good lender you're working with and they can walk you through the process. I mean, because there's still a lot of mortgages out there that are down in the 3 and 4% range.
Yeah.
That, man, if you could take over and assume that interest rate versus, today's somewhere in the sixes right now, I believe is our average. I mean, that would save you a ton of money.
Oh gosh, yeah.
Right. Next, of course, is owner financing. So depending on a seller situation, many sellers are in a position where if they don't need the money to go buy another home, or they're just in a good cash situation, they can decide to basically be the bank. So instead of making your payments to a bank, you make it to the person you bought your home off of. They can do that a number of different ways. There's land contracts, and they can actually give you a note and mortgage on the property. It's different, usually requires a certain amount of money down. You're not going to get, very rarely if I see anybody get like I don't even recommend it, 3% down. You're probably going to be expectations. I've seen some around 10%, but I would say norm is going to be around 15, 20, even 25%. The benefits though is, like, you may be heavy on cash as a buyer, but maybe you've got some of those hiccups on your credit that aren't allowing you to get a quality interest rate. It's a great thing for you. For the sellers, guess who's earning that interest? When you looked at that amortization table, it's still gonna exist.
Yeah.
And a seller may look at that and be like, wow, I can make $50,000 extra over this.
Yeah.
So essentially for them, they just sold their home for more money than they actually did. Right. So there's that's a great conversation. It's, people don't advertise a lot. It's out there.
It's unique. It doesn't happen a lot, but it is a unique opportunity.
Again, your seasoned agents, like that's not, we're gonna know how to ask for that, how to work with that, and how to get the right people involved if it's on the table.
Exactly. Yeah, exactly. So pre-approval, talk about all these things on what it looks like to get a loan, once you have a loan, but more importantly, it's that pre-approval. Really, prior to starting to look, we need a pre-approval, which means the lender has verified your income, assets, credit, so you can shop confidentially. I call it buying power. Pre-approval tells you what your buying power is today in today's market. Okay.
That's the message too to the seller when you're shopping and you're ready to write that offer. That's instantly to the seller, like, what is the buying power of this buyer?
Yeah.
So it's funny, like one of the last things we talked about today, but usually when someone calls me and say, hey, I want to buy a house, my first question is, do you think you'll be paying cash or financing? As soon as they say financing, what do I do first? Go get your pre-approval. It's just simple as that.
Yeah.
And then refinancing. So is when you replace your existing loan with a new one. Usually a couple different things here. Usually get a better interest rate, potentially changing your terms. I've refinanced in the past from a 30-year down to a 20. There's also cash out refis to, again, maybe do some of those home improvements, do some remodeling, new windows, roof, whatever. That those bigger ticket items. And you're like, hey, I don't want to use my cash. And if I just refinance and use the cash, again, the equity in my home, it works out really well because you've saved that cash on hand, and those repairs are going to increase the value in it.
Yep.
So you're still usually in a good equity positive.
That's right. It's like moving from box wine to a good Cabernet. Once your situation improves, you upgrade, right?
Yeah.
So yeah.
Except for that sneaky good box one that you find every once in a while.
They are out there.
So to kind of wrap up today, again, we were going over really just simplest ways to explain the terms. Would definitely recommend sitting down with this, but mortgage terms might be complicated, but really once you break them down, they're just tools. The tools that you're able to take advantage of once you understand them, and talk to professionals like us, obviously great lenders that will help you really make this sound as simple as it really could be.
Yeah, it's like parenting, running a real estate team, or picking a good wine. It's all about patience, planning and making informed choices. So, have that conversation. Yeah.
So thanks for hanging out with us today. I hope we managed to not put you to sleep on the basics of talking about mortgages. And again, anytime you need to reach us, you know how to get a hold of us. In our YouTube version, we always put links and stuff like that with our contact information. Otherwise, everybody have a great week, and we'll see you next time.
Bye, everyone. Have a great one.